Meantime, a very upbeat start to earnings season with the banks today. JPM, Citi, Goldman all beating on the top and bottom line. The KBE Bank ETF now up 1.5% as a result. Let's bring in Erika Najarian. She's a research analyst at UBS covering this space. Erika, and this is with high expectations. As we heard yesterday, you know, the financials were the area, along with tech, expecting to post the highest earnings growth, and they're clearing that bar. How so?
Yeah, so a couple of things. Number one, balance sheet growth is better because deposit growth is coming back. Card growth continues to be, pretty good and above normal. And obviously, capital markets activity is really coming off of lows. But the other thing, too, is the banks are able to reprice those deposits down as they reflect the cuts that we have had on their net interest margins.
And Citi and Wells in particular, as I'm watching this morning, the kind of continued drift higher. Why is that? What did investors hear, and kind of digest that makes them feel, usually it's the opposite. You might get a nice reaction and then they kind of moderate, but they're picking up some steam.
So what Citi and Wells is reflecting is entirely outside of macro. It's those individual companies getting better. So for Citi in particular, they actually lowered their return targets for 2026, but they went out there and said, look, we are going to buy back about $20 billion or 15% of our market cap to tide you over. And when your stock is trading that much below book value, that's impactful for investors. And for Wells Fargo, clearly that has been a makeover story as well on the regulatory side. But this quarter's results really sort of showed investors that they're sort of past just being a remediation story, and they're going to be a longer term return story where they could potentially earn more than their midterm target of 15% tangible ROE.
Gotcha.
So what you're seeing on the screen is really just those individual banks going from challenge to better.
So JP Morgan, let's not make too much of it, but, it doesn't have quite the same kind of pop in the shares today. It's up 1% or 2%. And is that just because of size? I mean, they put in strong results, maybe a little bit of the BlackRock phenomenon. Well, although BlackRock was up 6%.
Part of it maybe is that we're just so spoiled to JP Morgan's beat and raise, and obviously the valuation there is much higher for now for versus Wells and Citi and Bank of America. So that's a little bit of a ceiling on performance too. But honestly, I think the investors are sort of waiting to see what the company will do to unlock all that excess capital. They printed something like 15.7% capital, Kelly, and that's huge. That's a huge level of excess. And if we are really going to be in a deregulatory type of year, then the definition of excess could be even wider, even for JP Morgan.
So what are they going to do you think?
So I think they're going to grow. And that's so funny because the word grow is not usually associated with banks. But given where the stock is relative to book, I think what the company's priority is let's continue to build a moat around this business. The fact that there are the largest bank, in the world, and they have to hold the largest amount of capital and they can return 20% off of it, that is amazing. Wow. And I think that they're taking those earnings and, continuing to build a wide moat around the company. So I think that's what we're going to hear from them as we hear from the management teams over the next few months, especially ahead of their investor day in May.
All right. Solid start to the year with what could be a lot more to come. Erika, thanks. Appreciate it today.